this is the California. Here, let me exit so we can. This is a government website, so it's directly from the government. That means that it's not an advertiser paying for this advertising to get in front of you. It's well, I guess lobbyists are the ones that pay politicians to do what they do, and they provide the lawyers to write the laws for the politicians. It's not like the politicians sit there and write 100 pages. So there's money behind, I guess, a commercial and even whatever comes from the government. But I had a recent post that I was saying that it is not affordable, and I got some DMs from people. They're like, "What do you mean? I'm buying a house?" And yes, I know I have clients that can afford it, but I'm talking about statistically, there's a lot more people that cannot afford a house in California than there used to be years ago. So that means that the affordability is going up. If you want to look this up, I can provide you the link. Just let me know. Affordability chart for California. Google that. And the top website that comes up is, oh look, here's a California Association of Realtors post. It also has a affordability index. Here's another, the Public Utilities Commission, also another government website, but this is the main one that comes up. The California Legislature Nonpartisan Fiscal and Policy Advisor. Here is the affordability chart. California homes are about twice as expensive as the typical U.S. home. So here you have three lines. You see these three lines? The top one is let me see if I can actually turn on so you can see where I'm tapping. I'm gonna have to edit this a little bit. Oh no, not that. Okay. Oh, well, I guess I would have to done that earlier. All right, so the top line is a mid-tier California home. The bottom line, the dotted line, this is so this line, mid-tier California home, as of September 1st, from September 1st, so if I move along this line then, so we got June 1st is the last data that's on this one. But a mid-tier home is $787,000. And the U.S., a mid-tier home, comparable home, that's about half the price, $363,000. So California, if you go to the last data, $787,000, and the country, taking statistics from the whole country versus California. I'm assuming this is going to be the average cost of the home, $352,000, a little bit higher, $363,000. That's the last data. This third line that's in the middle, light blue, this is also California, but this is a bottom tier home, so I guess more affordable housing. We will read through it right now. So, but either way, overall in the country, the lower tier homes and the mid tier homes, the average homes, are all this. The higher you go, the less affordable that it is, because the houses are getting more expensive. And if you look at how much money people are making, people aren't making more money than they were before. Like the prices of the houses are higher than they were before. So maybe people are making more money, but the more money is not as much as the more money that it costs to buy. So that's what makes it unaffordable. Let's see, monthly payments for a typical, so the payments, household, so if a rent would be down here, a cheaper home and a medium home, you see so it's a lot more expensive to buy than it is to rent. That's another factor that is taken into account when measuring affordability. Let's read this. Housing costs in California have long been higher than the national average. In recent years, these costs have grown substantially, in some cases growing at historically rapid rates. In this post, we provide a brief update on housing cost and affordability in California. This is the chart that we already went through. California home prices far exceed the rest of the country. As shown above, California home prices have long been and continue to be much more expensive than the rest of the U.S. Prices for mid-tier homes are more than twice as expensive as a typical mid-tier U.S. home. Mid-tier homes reflect home values in the 35th to 36th percentile range. Okay, so this is the criteria to be considered a mid-tier home, which is the top line, right? There was a mid-tier for California, mid-tier for the U.S., and there's bottom tier, and 35 to 65 percentile range means, so if it's 50, it would be the center. So they're taking about 15% under and 15% over, and giving you a range that the prices of the homes that are pretty much the entire middle is a mid-tier home. And so that's what this is right here. So a mid-tier home would be something about 708, and if you go 15% above that or 15% below that, then that's what they consider as a mid-tier for the prices of the house. And then this one's going to be, let's see if we'll get to the other one. Perhaps even more importantly, a first-time home buyer, a bottom tier home in California is now about 32% more expensive than a mid-tier home in the rest of the U.S. A gap has widened over the last decade. Bottom tier homes are those with values in the 5 to 35th percentile range. Okay, so then this takes you from 50% down to 35%, which is 15%. So from 35% down from that would be the lower tier. So then I guess a higher tier would make this about 65% up to, I don't know, 90 something percent. It's a standard deviation if you're looking at a graph. If it's right within one standard deviation or out of one standard deviation, so in this case it would be the 15%. I don't know what it would be on it depends on what you're measuring. If it's more than that, it's significant, and this is significant enough to, I guess I'm getting too deep into this, but we're talking about affordability. Let's go back to, it's more expensive in California than it is across the country. Monthly payments, so this talks about the payment. So if your affordability gets compared to a bunch of different factors, and one of them, for example, is the income. And as Americans, we have had income growth from either minimum wages going up or people just paying more to their employees. So we have had income growth, but that growth is less than the growth that it costs to buy a home. So say you get a raise and you go from making $1,000 to $2,000, right? That means that your income went up, but say your monthly expenses went from $1,000 to $3,000, right? That means that it did not get more affordable because your cost of stuff went up more than the money that you're bringing in. That's one just basic way of looking at affordability. But let's see, dramatic increase in monthly payments for a newly purchased home since 2010. Monthly payments for a newly purchased mid-tier home, including mortgage, taxes, homeowners insurance, have increased dramatically over the last couple of years. Payments for mid-tier homes were nearly $6,000 a month in June 2024. An 84% increase since January 2020. Payments from a bottom-tier home went over $3,600 per month, an 89% increase since January 2010. Also, the gap between the monthly cost of purchasing a bottom-tier home versus renting are near levels that have not been seen since the housing bubble in the mid-2000s. This rapid increase in monthly costs for home buyers was driven by higher home prices and increased mortgage rates, both of which we discuss in more detail. Let's see this chart, this graph. Growth in monthly home payments since 2020 driven by both home prices and mortgage rates. Cumulative change in monthly payment for newly purchased mid-tier home in California. So this is for new homes specifically. It says cumulative change monthly for newly purchased mid-tier home. It says newly purchased. not really, that's not that clear, but let's see. Number one, total change in monthly payment. Two is, so this is what this means, the line, total change in monthly payment. So this is showing you what the change. So if right in 2000, no change, but then you go to 2021, it's pretty even with 2020, so I guess no change there. Move down to 2022, then it's 500. Move to 2023, you're at 2500. So it's just, that's what the black line showing you, the actual change. Compounding effects of prices and rates. Number two is the purple, compounding effects. So compounding effects would be the effect that it's put into place from, well, I need a better way to explain it. Compounding, phenomenal, here we go. Phenomenal where change in prices or interest rate not only affects the current value but also impacts future values due to the accumulative effect of change over time. So for example, if you were to open a interest bearing account 20 years ago, that every year it goes to maturity, and but you keep putting $1 every week for 20 years, you're gonna exponentially grow that in the 20th year than you would in the first or second year. So if I were to open an account and put $1 into it every week right now, the money that would go into it this first year or the first 2 years would not compare to if I've been doing it for 20 years. So my 20th year, the growth is exponential compared to what it grew in the first or second or third year, simply because in the 20th year, that stuff you did in the first year is doing its own little investing. You put your $1 in, it gets invested, you get your little return, but that money that you put in the 20th year has been doing that for 20 years. So every year that little bit gets bigger, and it's just like another person investing right next to you. That's what the compounding effect is. Let's see. So we got the number 3, mortgage rate change only. So mortgage rate change is the mortgage rate that you can get at the time. So right now, let's see, a year ago, I think we were at like 8% average rate. Right now we're like down almost to 6% an average rate. It's a little bit over that. So almost 2% we've dropped. So that's what the mortgage rate changed, and it's attributing each one of these pieces to those different factors. Number 4, home price change only. And number 4, this area here is showing you the prices of homes went up or down, the change of that. So I guess the biggest change here would be total change in monthly payment. Oh, and then each one of those is each piece of what's more significant and less significant, or what made the most significant and less significant change to that monthly nut you got to put out. Growth, well, let's see how the explanation is. Growth in home prices and mortgage rates have made purchasing a home much more expensive, as shown above. Monthly payments for a newly purchased mid-tier home have increased about $2,700 since January 2020. Okay, so from January 2020 till about now, it's $2,700 more to buy a house. In 2020, there was actually a slight drop in monthly payments as prevailing mortgage rates dipped. However, in 2021, rising home prices became the major drive of rising monthly payments, as home buyers had to take out large loans to pay for the more expensive homes. Subsequently, beginning in 2022, as the Federal Reserve began to increase interest rates to slow inflation, a mortgage rate became the primary driver of growth of the growing cost. The prevailing mortgage rate on 30-year fixed rate mortgage increased from 2.7% in January 2021 to 7.6% in October 2023. Mortgage rates declined to 6.9% in June 2024. Furthermore, when both mortgage rates and prices increase, there is a compounding effect on the monthly home payments as borrowers have to pay a higher interest cost on higher loan amounts. Okay, so the compounding effect, what they're talking about is not only does number 4, the price of the home, make the monthly debt more expensive, because if the price goes up, then your monthly payment goes up, even if the rate doesn't change. But in this case, it's saying the compound effect is because there's two things working together to make it more expensive, which is the number 4 area, the red, salmon, whatever color this is, color here, that 4, how it has that up and down, that's, well, from 2020 to now, it's, a lot more. That made it more expensive. And then if you look at the blue area, number 3, that is the mortgage rate. So not only you got the higher price, you also got the higher mortgage rates that are both working together to make it more expensive. And that's what the purple area is showing, that together, that's the change that happened. And that's why the black line is up there, because that includes everything. If it was just the blue alone, the black line would be laying on the blue. If it was just the red alone, the black line would be laying on the red. But it's laying on the purple because it includes both of these together. Good stuff. Purchasing a new 2-bedroom home is nearly twice as expensive as renting. That's another factor. Let's see what else we got. Let's keep going. If you want the link, let me know. If you want to hear more of this, let me know. It's pretty boring stuff, but it's interesting to me, and it's stuff that people should know. Medium household income, lower than income needed to qualify for mortgage on the bottom line. So this one's talking about the income that you need. Let's see, this one is mid-tier home. This is for a mid-tier home, bottom tier home, and this is a median household income needed to medium household income, mid-tier home. So you need, okay, this is what I was talking about. So if you take a mid-tier home or a lower tier home, this is the income that you need to qualify for those things, right? You see how the income that you need to qualify just keeps on going up way faster. And the lower tier, see how it goes up? This one right here, not this one, the blue one. See how it just goes up? This is from 2015, 2010, 2015, 2020, 2025, right? But here is what the actual income. You see how from 2005, 7, 8, 13, 14, 15, 20, no, right here, 22, right? You see how this line didn't go up as fast as for the cheaper homes and the median homes? That means that the income to qualify for those homes was this, but the average income of the American citizen, or I think this is for California, or for, this is Census Bureau, this is a little U.S. Census, so this is for the U.S. The income needed went up this fast, but the actual income that people have went up that fast, right? So that's why it's less, because here, you see how close it is to what people actually make, to what it takes to buy a house. Even here it's lower, right? That means a lot more people can afford. But then when the houses get more expensive, like right here, you need to, on average, make the $234,000 to qualify for the average home. But the average person makes 100 and, wait, come on. There you go. The average person is making 96,000. And it's not the average person, his household income is making 96,000. So if the prices of the homes didn't go up, maybe you would only need to make this much. That means a lot more people would qualify. That means it's more affordable. So, interesting stuff. Let's move on to the next one. See, cost of buying a home have grown by more than median income. Cost of buying a home have grown by more than median income. We already discussed that. Monthly home payments grown much more than the wages. So this is a payment compared to what people are making. Rents. So what people are making, what rents cost, what a mid-tier home costs, what a bottom-tier California home, mid-tier. So the homes went up this much, the rents went up this much, but the people actually making the money went up that much. Housing costs vary by location, especially for home buyers. Oh, okay, this breaks down the counties. And if we're looking, the light blue is rents, the dark blue is mortgage. So if you look down here, pretty close, and then it started separating. Rent still went up, rent still went up, just at a lower pace than purchases. Purchases went up a little bit faster. So it's much more expensive to buy than it is to rent. Again, points at unaffordability. Years generally higher in Southern California than Northern California. Cumulative growth in monthly payments for newly purchased bottom-tier homes in June. So this is measuring how much it went up more. So this green area up here compared to the darker blue area down here, the difference would be that it got more expensive from what it used to be. Then here it still got more expensive, just not as much as it got more expensive over here by comparison. So let's see. Read the description. Northern California has generally had slower growth than the rest of the state. Yeah, that's what it's saying. So there's more growth at the bottom than it has at the top. Housing costs have grown substantially in almost all areas of the state over the last few years. However, as shown in this figure above, the monthly costs associated with purchasing a bottom-tier home have grown more slowly in Northern California, most notably the Bay Area than many other parts of the state. There has been a similar pattern of rent growth across the state as shown in the figure below. Rents in the Bay have grown very little since 2020, while rents have grown by 40% or more in many other parts of the state. Oh, this is rent growth. So then this chart is home buyers cost growth. Okay, so this is the rents. So I guess the rents have been more expensive where you see the purples and orange, yellows are less. They still gone up, but not as much. And good stuff. All right. Toosdae.com, TOOSDAE.com, TOOSDAE.com.